Welcome back to the Deep Dive. Our mission here is, as always, pretty simple. We take these complex, sometimes contradictory stacks of research, financial models, all of it, and we try to distill it down into the insights you need for critical decision-making. And today we are going deep on PACCAR Inc. That's ticker PCAR, the heavy-duty truck powerhouse behind Kenworth and Peterbilt. But we are not approaching this as just another industrial company. I think for the serious investor, the real question here is whether PACCAR is, a high-quality compounder disguised within a cyclical industry.
Right.
The idea is that their whole operating model, it creates this kind of structural resilience, almost like an intrinsic valuation floor that the market just habitually seems to undervalue whenever the cycle turns down.
And that's the whole puzzle, isn't it? It's that dichotomy that makes PACCAR such a fascinating case study right now. I mean, look at where they're operating. It is, and I don't think this is an exaggeration, the most challenging intersection in their entire history.
How so?
Well, on one hand, you've got the immediate pressure, the freight recession, as they're calling it. Demand is normalizing, and that's already hitting their numbers. Truck revenues are way down year over year. But at the exact same time, they have to fund the single most capital-intensive transformation this industry has ever seen. The pivot to zero-emission powertrains, to autonomous driving, it's a massive undertaking.
So it's a classic case of managing the short-term cycle while investing for a completely different long-term future.
Precisely. And our deep dive today is going to focus on the three big structural advantages PACCAR uses to insulate itself from the kind of volatility that, frankly, just crushes its peers.
Okay, let's lay them out.
First, we'll hit the brand equity, that untouchable quality, and how it translates into a real-world total cost of ownership benefit. Second, what we're calling the profit sanctuary of their parts business, which is just a rock of stability. And finally, we'll look at the balance sheet itself, the fortress balance sheet, built on a capital discipline that's allowed PACCAR to generate net income for, get this, 86 consecutive years.
86 years.
Okay.
That's a track record that is certain. Well, it demands a much closer look. All right, let's start there. Let's unpack this structural advantage, starting with what might seem like the softest factor, the brands. I mean, in heavy industry, you always hear that brand is secondary. It's all about price. It's all about utility. But for PACCAR, the brand equity of Kenworth and Peterbilt seems to be the main engine driving their margins.
It absolutely is, and it's because these trucks, they're not just tools. For the people who drive them, they are genuinely aspirational products.
And that has a real business impact.
A huge one. It translates directly into a critical business metric, driver management. Think about it. In North America, the driver shortage is a chronic structural problem. It is the #1 constraint on fleet growth. So fleets, what do? They use premium PACCAR equipment as a non-monetary tool for recruitment and retention.
So offering a driver a brand new long-nosed Peterbilt,
Yeah.
that's like a signing bonus you don't have to pay taxes on.
That's a great way to put it. Or a highly optioned Kenworth T680. It's a quantifiable benefit that directly lowers their turnover costs. It's a capital expense that supports their human capital. It's a real ROI for the fleet owner.
And that perceived premium, you can see it right in the pricing. Our sources are pretty clear on this. PACCAR consistently commands, a 10 to 15% pricing premium over its competitors?
That's the range. 10 to 15% over functionally similar trucks from, say, Daimler's Freightliner or Traton's Navistar. And that difference, it's not really about having superior technology. It's pure brand value, perceived quality.
And crucially, the expectation of resale value.
Now you're getting to the heart of it. The real financial mechanism for you, the investors, is when you stop looking at the initial sticker price and you shift your focus to the total cost of ownership, the TCO.
This is the nuance that everyone needs to grasp.
It is, because while the PACCAR truck might cost you 15% more upfront, its residual value, its resale value, at the end of a typical 4 or 5 year cycle is dramatically higher.
Okay, let's just run some back-of-the-envelope numbers on that, because this is critical. Let's say a competitor's truck is, $180,000.
Good number.
So a 15% premium puts the PACCAR equivalent at around $207,000. So $27,000 more upfront.
Right. But now let's look at 5 years down the line. Let's assume the PACCAR truck retains, say, 50% of its value, which is pretty standard.
Okay.
And a competitor's truck retains only 35%. That resale premium for the PACCAR truck is suddenly worth Well, it's worth more than the initial $27,000 premium you paid.
So over the full life cycle, the PACCAR truck is actually cheaper to own.
Often, yes. The higher residual value systematically lowers the depreciation expense, and that makes the effective TCO lower than the so-called cheaper alternative. It is a brilliant model.
And that's the virtuous cycle you mentioned.
That's the validation loop. It's self-reinforcing. The market pays a premium for the new truck because the resale market guarantees that premium will be largely recovered. That strong residual supports the high new truck price, which feeds the high margins, which generates the cash for the superior ROIC we'll talk about later. It's just a fundamental structural advantage.
And they support this with a very specific geographic architecture, right? It's not just one brand everywhere.
No, it's very smart. In North America, they have the dual brand strategy, Kenworth and Peterbilt. Together, that gives them a combined Class 8 market share of around 30.7%.
Why two brands, though? Why not just focus all their efforts on one?
It's a masterstroke in market segmentation. Underneath, they're sharing a ton of core components, leveraging massive economies of scale. But on the surface, they're targeting completely different customer psychologies.
So Peterbilt is?
Peterbilt has historically been the prestige brand, the classic long-nose tractor. It appeals heavily to the owner-operator, the guy who owns his own rig and prioritizes image, personal comfort, that sort of thing.
And Kenworth.
Kenworth, especially the more aerodynamic models like the T680, is often pitched to the huge national fleets. The guys whose decisions are driven purely by spreadsheets, fuel efficiency, and TCO metrics. So they capture this huge swath of the market without diluting the premium image of either brand.
And then internationally, it's all about DF.
DF is their global spearhead. And they're not just a minor player. DF has dominant market share in key European markets, like the UK, where they have over 27%. And they're making really serious inroads into high-growth markets.
Like Brazil. I saw they had a record market share there.
9.9% in the Brazilian heavy-duty segment. And that's a bellwether, because Brazil is a tough, competitive market. It shows they can execute this premium strategy outside of the protected North American oligopoly. It's all about diversification. A downturn in the U.S. might be offset by strength in Europe or South America.
Okay, so if the brand equity and the resale value sets the pricing floor for the trucks, let's talk about what sets the income floor for the entire company, the parts segment. You called it the profit sanctuary.
And for very good reason. This is the classic razor and blade model we all know. The new truck sale is the razor, and that one-time sale generates decades of recurring, incredibly high-margin demand for the blades, the parts.
It seems simple enough.
The concept is, but PACCAR's execution is on another level. I mean, a new truck creates an asset that's in service for 15, maybe 20 years. And for that entire lifetime, it needs service, it needs maintenance, and crucially, it needs proprietary PACCAR parts. This segment is completely decoupled from the new truck sales cycle.
And there's a specific metric that really illustrates the resilience here, right? The absorption ratio.
Yes. Every serious industrial investor should know this metric. The absorption ratio, it quantifies what percentage of a dealer's fixed overhead cost, we're talking rent, utilities, salaries, is covered only by the gross profit from parts and service sales. It excludes new truck sales completely.
And the numbers we've seen for PACCAR dealers are, frankly, they're staggering. The ratio is well over 100%. The example we saw was 132.2%.
Let's just pause on that. 132%. That is the fundamental difference between a high-quality franchise network and just a typical industrial distributor.
So what does that mean in a downturn?
It means everything. If a dealer's absorption ratio is, say, 85%, they are losing money hand over fist when new truck sales are wink. They have to start panic discounting, laying people off. Some even go bankrupt. But at 132%, it means that PACCAR's dealership network is structurally profitable even if new truck demand went to zero tomorrow. They just don't face that same existential crisis their peers do in a deep trough.
But hold on, couldn't a critic argue that PACCAR doesn't own all those dealers? Isn't that putting a lot of operational risk outside their direct control?
It's a fair question, but the model is all about aligning incentives. By making sure the dealer network is profitable and insulated from the cycle, PACCAR guarantees service uptime for its customers. That stability is what maintains the high residual value of the trucks.
Which in turn supports the new truck pricing premium we just talked about.
You've got it. It's another one of those virtuous cycles. They don't have to own the storefronts because they own the economic engine, the parts business, that keeps the whole network robust and reliable. That's what protects the brand.
And let's put some numbers on the margins here. The core truck segment. Its margins are cyclical, what, 8 to 12% in the good times?
Right. But the parts segment, it operates on a totally different planet financially. We're talking consistent gross margins in the 25 to 30% range,
Consistently.
like clockwork.
Hmm.
In the third quarter of 2025, and remember, that was a soft quarter for new truck sales, PACCAR Car Parts hit a record revenue of $1.72 billion with a 29.5% gross margin. That high-margin, low-volatility revenue is the true anchor of the entire company's valuation.
Which brings us to a really key strategic shift they've made. Vertical integration to capture more of that aftermarket.
Yes, this has been a huge focus for them. It's both a defensive and an offensive move. By aggressively pushing their own proprietary powertrains, the PACCAR MX engines, the TX transmissions, their own axles, they are intentionally locking the customer into the PACCAR aftermarket ecosystem.
So before, if you had a Cummins engine in your Kenworth, a lot of that service revenue would go to Cummins or an independent shop.
Exactly. That revenue was leaking out of their system. Now, PACCAR captures those high-margin part streams for engine components for the entire life of the truck. It just makes that profit sanctuary even more durable year after year.
So every truck they sell today is locking in high-margin revenue for the next 15 years.
That's the plan.
Okay, we've covered the brand, the aftermarket. Now let's get to execution. PACCAR has this reputation for incredible operational discipline. They're consistently cited as the most capital-efficient manufacturer in the whole sector. What's the secret sauce there?
It's their rigid, almost religious commitment to the build-to-order model. It sounds simple, but it's incredibly hard to maintain.
What does that mean in practice?
It means they don't engage in speculative production runs. They don't build trucks to just sit on a lot hoping someone will buy them. This minimizes their finished goods inventory, which has a massive impact on working capital and inventory risk.
Yeah.
When a downturn hits, they aren't left holding a bunch of aging, expensive assets.
So they can run leaner.
Much leaner. Lower days sales outstanding, lower days inventory outstanding. It means they convert revenue into cash much, much faster than their peers. And in a capital-intensive business like this, mismanaging working capital can absolutely destroy your profitability.
And the ultimate report card for all of this, the final quantitative proof, is return on invested capital, ROIC.
This is where PACCAR really shines. Their normalized 3-year average ROIC is estimated at about 16%. Now, that's impressive on its own. It's well above their cost of capital. But the key is the comparison. It blows away the peer group average. That's the sign of a real structural advantage.
And we have to talk about the peak ROIC number. The 37.8% they hit in 2023. That almost sounds like a tech company number, not a heavy manufacturing company. How is that even possible?
It's a combination of two things: immense operating leverage and a very low capital base. During that 2023 peak, they had everything going for them. Record high factory utilization, incredible pricing power because of all the supply chain shortages.
Right.
And because PACCAR has always maintained such a conservative capital base, especially minimal debt on the industrial side, the denominator in that ROIC calculation, the invested capital, is just structurally lower than their peers. So when you get record net income hitting that low capital base, the ROIC number just skyrockets.
It confirms the strategy. They prioritize return over sheer volume.
That's the difference between a compounder and just a volume player.
All right, let's pivot from the moat to the foundation that supports it all. Financial discipline and capital allocation, this fortress balance sheet they're famous for. For an investor focused on downside risk, what does their liquidity position look like today?
It is genuinely pristine. The industrial manufacturing segment, just that part of the business, is holding $5.9 billion in cash and marketable securities.
$5.9 billion.
Yeah, it's a massive shock absorber. It means they don't have to run to the credit markets or slash critical R&D spending when the cycle turns down. And on top of that, their credit rating is A plus A1. That's one of the highest for any global industrial company. They are not dependent on anyone for their core operations.
But when you look at the consolidated balance sheet, you see a debt number of around $15.9 billion. We need to unpack that because just looking at that top line number is really misleading.
It's the crucial nuance that a lot of generalist analysts miss. The manufacturing segment, the part that actually builds the trucks, carries virtually zero net debt.
So where does that $16 billion in debt come from?
The vast majority of it belongs to PACCAR Financial Services, or PFS, and that debt is directly matched by $22.4 billion in income-generating assets, the loans and leases they provide to their truck customers.
So PFS is basically their in-house bank.
Exactly. It's a captive finance company. It uses its own highly rated low-cost debt to help customers buy trucks, and it generates its own pre-tax income. I think it was $126 million in Q3 2025. This separation is key. It keeps the core industrial business completely unlevered and incredibly conservative.
But doesn't running a giant finance arm like that introduce a different kind of risk? Credit risk? I mean, if this freight recession gets really bad and fleets start defaulting on loans, PACCAR is on the hook for that through PFS.
They absolutely are, but their credit portfolio is famously conservative. They're lending mostly to high-quality established fleets who are buying
Pre trucks.
premium trucks, which, as we've already established, retain superior residual values. So even in a worst-case scenario where PACCAR has to repossess a truck, the higher resale value of that Kenworth or Peterbilt minimizes their loss compared to a competitor taking back a lower-value truck. It's a totally integrated risk mitigation strategy.
Let's talk about how they return capital. PACCAR's dividend policy is one of the clearest signals of their management's long-term thinking. They don't use the rigid payout ratios that you see with other industrials.
It's a textbook case of responsible cyclical management. They use what we call a bifurcated structure. The first piece is the stable, growing quarterly dividend.
The predictable part.
The predictable part. It's grown about 12% annually over the last 5 years. That signals management's confidence in the consistent structural growth of the parts and services business.
And then there's the second piece, which is the really interesting one. The variable, often very large special dividend at the end of the year.
Right. The special dividend is their tool for returning the cyclical excess cash flow back to shareholders without creating a fixed obligation that could break them in a recession. The goal is to pay out about 50% of net income. But, and this is critical, they do it over the cycle, not in every single year.
And we saw this play out perfectly just recently.
We did. After the huge earnings of 2023, they paid out a massive $3 year-end special dividend in January 2025. But then, reflecting the softer earnings of 2025 and the need to conserve cash for all this new tech, they declared a more conservative but still very significant $1.40 extra dividend in December.
That flexibility is a huge advantage.
It's everything. It rewards the long-term shareholders who stick with them, but it prevents the company from ever having to take on debt or, heaven forbid, cut that stable quarterly dividend just to meet a payout target. The stability of that quarterly dividend, which they've paid without a single interruption since 1941, by the way, just reinforces the quality of the business.
Another thing that defines them is what they don't do.
Yeah.
They avoid these massive, risky, empire-building acquisitions that have just littered the industrial landscape with write-downs and integration nightmares.
That M&A discipline is foundational to their high ROIC. They only put capital to work where they know they have a competitive advantage. You can see it in their 2025 projections. $700 to $800 million in capex, $450 to $480 in R&D. These are big numbers, but they're incredibly focused.
Let's look at where that money's going. The big strategic move on the tech front is this multi-billion-dollar joint venture, Amplify Cell Technologies.
Right. This $2 to $3 billion JV with Daimler and Cummins is classic PACCAR risk management. They're building a 21 gigawatt-hour LFP battery cell factory in Mississippi.
LFP, not the nickel manganese cobalt chemistry we see in most passenger cars. Why?
Because lithium iron phosphate, or LFP, it's a trade-off. It has lower energy density, but it is significantly safer. It's cheaper to produce, and it has a much longer life cycle, all of which are paramount for a commercial truck that's running 24/7. And by doing it as a JV, PACCAR de-risks the huge capital outlay while also securing a USMCA-compliant, localized supply chain.
They're also investing in the circular economy with a new remanufacturing facility. That sounds like a direct boost for the parts segment.
It's a pure high-margin play. Remanufacturing takes used engine components, restores them to OEM specs, and sells them at a lower price than new parts, but at a far superior margin to selling a new truck. It closes the loop on their ecosystem and lets them monetize the entire life cycle of the asset.
And we see that same focused approach internationally with a DADAV factory expansion in Brazil.
Yes, that's them putting capital right behind their recent success. They're investing in proven organic growth, not just speculating on new markets. It's why their share count has been basically flat for a decade at around 525 million. They use buybacks mainly to offset stock-based compensation, which tells you they prefer the cash dividend as their primary method of capital return. It's all about operational stability.
Okay, so we've firmly established the quality of PACCAR, Now we have to stress test it. Let's bring in the external pressures, starting with the most immediate one, the current cyclical correction. How bad is this freight recession for the core business?
The data is pretty clear. We are well past the peak. Net income was down 9.6% for the full year 2024. And the latest numbers we have, Q3 2025, showed truck revenue down a very sharp 27% year over year.
And what's driving that?
You have spot rates for freight that have just collapsed, contract rates are softening, and there's a huge oversupply of trucking capacity out there from the massive fleet expansion we saw during the post-pandemic boom. All that excess capacity just crushes demand for new trucks.
PACCAR's own outlook reflects that. They're forecasting the 2025 U.S. and Canada market to be at a cyclical low, somewhere between 230,000 and 245,000 units. That's a huge contraction.
It is, and this is where you really see those internal shock absorbers get put to the test.
This is the moment the thesis gets proven or disproven.
Right, and look what happened in Q3. While truck revenue plunged 27%, what did the parts segment do? It grew. It was up about 4% year over year to a record level. Financial services was also up 5.5%. That divergence parts growing while trucks declines, that is the visible proof of the structural mitigation thesis. It stops the whole company's margins from collapsing.
And we should probably mention the vocational segment here too, the non-long-haul trucks.
That's a great point. The vocational segment, dump trucks, concrete mixers, that sort of thing. That's a segment where Kenworth and Peterbilt are very strong, and it's much more resilient right now. It's being supported by multi-year federal infrastructure spending, so that demand is much less sensitive to the immediate freight cycle, and it provides a really crucial buffer.
Okay, let's move to what might be the biggest near-term risk on the horizon. The EPA 2027 regulatory disruptor. This isn't just a small change. It is a massive market-distorting shock.
It really is. The new standards require much, much tighter control over NOx emissions across the entire operating range of the engine. This means far more complex after-treatment systems, enhanced SCR systems, better particulate filters, dual-dosing DEF systems. It's a ton of new, complex hardware.
Which carries a huge cost. The estimates are an additional $20,000 to $30,000 per truck.
That's the number everyone is focused on, $20,000 to $30,000. And when you have a cost shock of that magnitude, it historically triggers one thing.
The pre-buy demand cliff.
Exactly. The logic is simple. If you're a fleet manager, why would you buy a new truck in 2027 that costs 30 grand more, is way more complex, and is probably going to have more maintenance issues when you can just load up on the simpler, cheaper 2026 model?
So everyone rushes to buy trucks in 2026, creating this temporary boom.
The pre-buy frenzy. But the inevitable consequence of that is you pull forward a huge amount of demand, which leaves a total vacuum.
The demand cliff.
The demand cliff in 2027 and probably into 2028. You have all this excess capacity that was bought cheap in 2026 flooding the market, so nobody needs new trucks for a couple of years. This is the single biggest structural risk hanging over PACCAR's valuation right now. Management has to perfectly time this massive production ramp in 2026 without getting caught with tons of inventory when the bottom falls out.
So the test for PACCAR is whether the parts division can cushion what could be a very deep two-year contraction in new truck sales caused by this one event.
That's the whole question.
Let's shift to a longer-term threat. The North American market is pretty insulated by tariffs, but PACCAR is a global company, and the competitive landscape globally is changing fast because of China.
It is. PACCAR has always competed in this disciplined oligopoly with Daimler, Volvo, and Traton. It keeps pricing pretty rational, but now you have these Chinese OEMs like Sinotruk and BYD who have massive domestic overcapacity, and they are aggressively pivoting to export markets.
And the numbers are huge. Sinotruk's heavy-duty exports were projected to hit, 135,000 units in 2024?
That kind of volume creates immediate deflationary pressure, especially in PACCAR's key growth markets.
Like South America, where DF has been gaining share.
Precisely. And the Chinese aren't just exporting cheap diesel trucks, they are leading the charge on electrification in those markets. Our sources show Chinese companies already control over 70% of the new energy vehicle segment in Brazil. That is a massive challenge for DF's premium pricing model. If a competitor can offer a lower TCO with an electric truck, DF's position becomes very vulnerable.
So even if the North American moat holds, PACCAR is now forced to spend more capital just to defend its market share in places like Brazil because the EV transition is being accelerated there by foreign competition. The whole game just got more expensive.
It did.
Which is a perfect segue. Let's talk about how PACCAR is navigating this technological transition. It requires huge capital, which is kind of the opposite of their historical model. Their strategy seems to be one of technological agnosticism.
I like to call it vertical integration light. It's all about prudent risk management. They're developing a whole portfolio battery, electric, hydrogen fuel cell because they don't want to bet the entire company on one unproven technology for the entire Class 8 market. And they're using JVs to de-risk the massive capital spend.
On the battery electric front, we're seeing models like the Kenworth T680E and the Peterbilt 579 EV go into production. But the big capital move is the Amplify Cell Technologies JV.
Right. With the LFP chemistry we talked about, it's the right choice for heavy trucking.
But let's push back on this a little bit. EV adoption in heavy trucks is still incredibly slow. It was only 0.5% of market share in Q1 2025. And crucially, that big Amplify battery plant has already delayed its start of production from 2027 to 2028.
That delay is a critical signal. It tells you the entire industry is recognizing just how hard this is. The lack of charging infrastructure, the weight penalties of the batteries, the high upfront cost, it's all slowing down fleet adoption. PACCAR is being prudent, but there is a risk. If a competitor like Volvo goes all in and accelerates, PACCAR's fast follower strategy could cost them market share if the transition suddenly takes off.
Which is why their hydrogen fuel cell strategy is so important.
It's essential because batteries just don't solve the physics problem for heavy long-haul trucking. The weight of a battery pack needed for an 800-mile range would destroy your payload capacity. It just doesn't work.
So their partnership with Toyota is key.
It's their answer for the high-margin long-haul segment where their brands are strongest. Toyota brings the proven fuel cell tech. PACCAR brings the premium truck and the distribution network. It ensures they have a zero-emission solution for their core market.
And beyond just propulsion, their tech strategy is also about data and connectivity. PACCAR Connect.
Yes. This is a defensive moat in its own right. They have their proprietary telematics system in over 465,000 vehicles. By controlling that data stream performance, maintenance codes, all of it, they stop third parties from getting between them and their customer. The data feeds right back to their parts and service centers.
And the investment in platform science makes that ecosystem even stickier.
Right. Platform science lets fleets integrate all their complex software logistics, compliance, whatever, directly onto the truck's native system. No more bolting on a bunch of aftermarket gadgets. It just makes the PACCAR ecosystem that much harder to leave. It's a software moat on top of their hardware and service moats.
And then for autonomy, their partnership with Aurora lets them maintain that capital discipline.
It's a brilliant move. PACCAR focuses on what they do best, building a robust, reliable, autonomous-enabled truck chassis. They let Aurora, the software expert, bear the insane R&D costs and regulatory risk of actually developing the Level 4 autonomous system.
So as the truck becomes more of a software platform, the execution risk goes up, right? PACCAR's reputation is built on reliability. Software introduces a whole new way to fail.
It's a huge and growing concern. We just saw an example of it with the recall of over 56,000 Kenworth and Peterbilt trucks. It was a software defect affecting the lighting and lift axles. Now, they fixed it, but it shows how a single glitch can compromise a huge number of vehicles instantly. The stakes for a failure in a fuel cell system or an autonomous steering system are orders of magnitude higher.
Which makes management stability and alignment absolutely critical. Are they incentivized to prioritize long-term quality over short-term sales?
They are. PACCAR's leadership is famously long-tenured and conservative. And their compensation, especially the long-term incentive plan, is tightly aligned with shareholder interests. It's heavily weighted to things like ROIC, return on sales, and net income growth. And it's benchmarked directly against their main peers, Daimler and Volvo. Management only gets rewarded for true structural outperformance, not just for riding the cycle.
Okay, let's bring it all together. We've established PACCAR is a blue-chip industrial. Now for the crucial question. What is the market charging for that quality? And is it a fair price?
Right now, PACCAR is trading at a trailing PE ratio of about 21.8. That is a premium valuation. It's near its 3-year high, and it's well above its historical median of around 13 or 14.
So the market is clearly optimistic.
It's anticipating two things. A big rebound from the cyclical trough in 2026, and it's putting a permanently higher value on the resilience of that parts business.
So to really understand the valuation, we have to do a sum of the parts analysis. We need to strip out the stable, non-cyclical businesses to see what the market is paying for the cyclical truck business itself.
And this is where it gets really interesting. Let's start with the parts business. It's stable, it's high margin. If we put, say, a conservative 18 times PE multiple on its $1.7 billion in pre-tax income, that segment alone is worth roughly $30 billion.
$30 billion. And then you have the financial services arm.
Right, PFS. We can value that at about 1 times its book value, given the quality of its loan book. That adds another $5 to $6 billion to the total value.
So $30 billion for parts. Let's call it 5.5 for PFS. You're at $35.5 billion of structural, non-cyclical value right there.
Exactly. Now, what's the total market cap of the company today? It's about $41 billion.
So if you subtract that $35.5 billion, it implies that the entire cyclical truck manufacturing business, the part that's exposed to the freight recession and the 2027 demand cliff, is being valued at only about $5.5 billion.
Which is a pretty conservative valuation. It implies the market is pricing the core manufacturing business at a mid-single-digit multiple through this trough. So the SOTP analysis, it actually justifies that high overall PE ratio because it confirms that most of the value is coming from those stable, high-margin anchor businesses. The premium is for stability, not for cyclical growth.
Okay, so let's synthesize this for the experienced investor. PACCAR is, without a doubt, the highest quality asset in the global heavy truck industry. They've successfully lowered their cyclical beta. They are a blue-chip industrial.
The investment thesis absolutely holds. It is a quality compounder built for the long haul. The problem is the current price reflects a lot of that quality, which might limit the near-term upside. The primary concern is purely one of timing, and it's all dictated by that 2027 demand cliff.
So the suggested action here is something like hold or accumulate on weakness. Patience is the key.
That's it. You should be looking for a market overreaction. A tactical window to get aggressive would open up if the stock were to pull back towards its historical median valuation, that 15 times earnings multiple. Any kind of market panic about the 2027 or 2028 trough that temporarily hammers the stock price? That would be a superior entry point for long-term compounding, given the balance sheet.
Let's wrap this up with a final takeaway.
I think the central finding is that PACCAR's quality is simply not up for debate. Their commitment to ROIC, the fact they have zero manufacturing debt, and that incredible 86-year streak of net income. I mean, they navigated the Great Depression, World War II, the Great Financial Crisis. The resilience is proven.
So for you, the listener, what does this all mean? The question isn't about quality. It's about whether you have the patience to navigate this imminent, predictable, regulatory market distortion in 2027. The parts division is a fantastic anchor, but can it fully cushion the impact of a $30,000 cost shock that induces a massive 2-year demand cliff? That is the risk you have to time.
And that leaves us with a final provocative thought to chew on, focused on that ZEV transition. Given that the big battery JV is now delayed until 2028 and EV adoption is still stubbornly low at 0.5%, should PACCAR rethink its whole posture?
What do you mean?
Should they lean more aggressively into their proven hydrogen FCEV strategy with Toyota? Really try to differentiate and dominate the long-haul segment where batteries don't work? Or does sticking to this fast follower approach just leave them exposed to having their market share slowly eroded over the next decade, especially by these aggressive EV-first Chinese competitors in global markets?
A question that demands some critical thought as this industry heads into its most disruptive period ever. That's all the time we have for this deep dive into PACCAR. Go forth and continue your analysis.